Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with David Schassler, who's the Head of Multi-Asset Solutions at VetEck. David, great to have you on the show.
Thank you so much.
Absolutely. So, David, gold is all over the headlines. It's been hitting record high after record high. I think it hit $3,500 per ounce at one point. A lot of people have pointed to various different factors for driving this rally. What do you think are the major catalysts that are pushing gold to such lofty levels?
I couldn't dream up a more bullish environment for gold. Couldn't dream it up. You've had a period of inflation that's lasted. COVID happened in 2020. We're here in 2025. We've had persistently elevated inflation for a long time. That whole narrative about transitory clearly didn't work out. So now we're sitting in a situation where inflation's still persistently above averages. Our view on inflation is that we stay in that elevated but tolerable level of inflation, call it 3 to 5% for an extended period of time. Now, that's the first part of it. The second part of it is that huge debt, right, huge spending, all contributing to the inflation, geopolitical chaos, and now pushing us towards a recession, right? So you've got all those factors. And here's the thing. We came out pretty early and said this, and we effectively said in the beginning part of the inflation cycle, gold does good, not great. Gold does great as you're years into the inflation cycle. The reason being is because gold doesn't have the utility of other assets. People have to buy it to solve a problem. The problem to solve is inflation and protecting their purchasing power. Right now, people are sick of being tired. Being told that they don't have a problem. They clearly know that they do. They want to protect their portfolios, and that's what's driving people into gold.
Yeah, it's been an absolutely incredible rally, David. Back in 2022, gold saw a bit of a sell-off along with all of the other assets that are out there. And it bottomed out around $1,600 an ounce. Now it's, like I said, near $3,500 an ounce. It's double. Do you think this rally has further to run, or is all those bullish catalysts you talked about, inflation and things like that, already priced in?
We think there's a lot more room to the upside. So let's break that down for you. Gold as a store of value asset, again, solves a problem. The supply on gold is pretty constant over time. Gold is now the top performing asset relative to the S&P 500 and really comparable to all major asset classes over the 1 year, the 2 year, the 3 year, the 4 year, and we believe soon enough to be the 5 years as this gold rally continues. So that's the setup. Now, you've got most investors that just don't own gold. Most people, when I speak to them, don't have an allocation to gold. Maybe I'll say that another way. Most people don't have an allocation to the top performing asset that's specifically designed to hedge against the exact risk that we're dealing with right now. So that's the setup. Now, the gold market's a lot smaller than the equity market's a lot smaller than the fixed income markets. So if just a very small percentage of investors reallocate from their equities or their fixed income into gold, you could easily see a situation where the price of gold doubles. Does it happen overnight? No, but we think eventually we get there. In 2025, we think that gold can easily see $4,000 an ounce. In 2026, we think that gold can go to $5,000, right? We think that that's all on the table and a realistic expectation. Will we be exactly right about the timelines? No. Do we think that gold's actually going to get there in a reasonable timeline? We absolutely do.
Wow, that would be incredible. How do you go about valuing gold? Obviously, stocks, you can point to things like earnings and cash flow. How do you put a value and a price target on gold?
I think the best way to think about the price targets of gold is look about the historical sensitivity of gold demand to gold prices. And when you look at that, you'll see historically, there's been central banks buying. There's been a path towards de-dollarization that's been happening for a long time. So they've been natural buyers in the gold market now for decades. What's changing now, and you saw a big material increase in gold flows into ETFs, there's sensitivity of the gold price to those inflows that are coming in. So when we think about what's our expectation of gold prices, what we're doing is we're saying, how much reasonable demand do we think is going to come from the investment market, from the return of the Western investor into an asset class that they don't own? And what's the sensitivity to price to those asset flows? And when we do that, we back into the numbers that I said before, because we do think that gold eventually, in the not too distant future, we will see up to $5,000 an ounce.
And you talked about this, David. Not a lot of investors are investing in gold right now. You expect that to increasingly change over time. For investors who might be interested in allocating to gold for the first time, How much of your portfolio do you recommend that they put into gold?
Most people that I speak with, unfortunately, have a 0% allocation to gold. Zero. Our ask, reconsider that. Reconsider taking your allocation to gold to around 5%. We think that that's generally the right amount. It can provide you the portfolio shock absorbers that you need during risk-off events, and also that hedge against the de-dollarization, the inflationary pressures, and the geopolitical chaos, et cetera, that we spoke about before. Number's 5.
And David, you have this one ETF that invests in gold, but it also invests in a bunch of other real assets. That ETF is called the VanEck Real Assets ETF, RAXX. What percentage of this fund is allocated to gold, and what else does it hold?
Yeah, so the VanEck Real Asset Fund, RAAX, is a diversified real asset solution. So we own 3 types of real assets. The first type, resource assets, the commodities and natural resource equities, the companies that benefit from the extraction, distribution of commodities, operating leverage within there. So that's the first part of it. Second part, income generating real assets, think REITs, infrastructure, MLPs, real assets that spit off a yield. And then there's the third part. And the third part's exactly what you said, which is gold. We've got a very heavy allocation. We've had a max gold allocation for about 3 years now. Super optimistic on the price of gold, think gold's going higher. That's obviously fared well for the portfolio. But if you really kind of just think about what's that solution, what's RAX, and how does it fit, it's the one-stop shop for real asset investing. You put that into your portfolio, allocate to it, and allow us to do the work of when should you be allocated to gold, when should you increase the allocation, when should you decrease it, et cetera. That's why that fund exists.
And is this an active fund?
Yes, it is.
Okay. And how do you go about deciding how much to allocate to gold versus all these other real assets that are in the portfolio?
Yeah, so the process at a high level, we do lots of work understanding what are the right real assets to own. That's step one. We've written papers about which real assets to allocate to during periods of inflation, how certain real assets do during accelerating, decelerating growth. So the first part of it is understanding what are the right real assets to own. That's the first part. Those are the assets that we just covered. The second part, so that's the what. How to allocate is we use an optimization process that helps maximize diversification by minimizing volatility. So that helps us guide the asset allocation to how do we create a stable framework. And then there's the last question, which is the when, which is what you just asked. And that's when do you overweight gold? When do you underweight gold? So we use quantitative techniques as well as our fundamental understanding of the individual asset classes. So what's the market pricing telling us? What's the volatility of the market telling us? If gold just shot up to the moon, maybe it's time to take a little bit off the table, et cetera. So it's a very active process. The turnover is not huge, but there's eyes and ears on this portfolio every single day.
And David, you talked about how investors should have 5% of their portfolios in gold. How about something like this ETF? Is it a part of that broader alternative sleeve that some investors might have in their portfolio? How do they decide how much to put in this ETF? And what type of investor should buy this ETF in the first place? Should it just be any ETF can benefit from this, or is it a specific type of investor?
Yeah, so we run asset allocation portfolios as well. And our asset allocation portfolios are they're designed for investors to solve these individual problems that you just laid out. And our real asset allocation is 8.5%. So we're running heavier we have a pretty hefty allocation of real assets. And within RAX, it's about a third. So I would own more of this so I said 5% for gold, all in on gold. I think about this as a diversified real asset solution. I think that commands a larger weighting within the portfolio. So anywhere from 7.5% to 10%, I think could be totally reasonable given how much diversification is embedded with this and how much it could potentially add to your portfolio.
David, we've been hearing a lot about how people have been increasingly interested in investing in private markets, things like private credit, private equity. And also included in that is real assets. And some people have gravitated towards these private real asset funds that directly invest in things like infrastructure and natural resources and things like that. This is obviously investing in public equities and things like that, as well as gold. So how do you see those two kind of comparing? The private funds that maybe directly in private real assets versus, this is taking a more public approach.
Our general approach when it comes to portfolio construction is anything can fit, meaning that public versus private, we could see a rationale for both of those. The simplicity of the public side of it is that you can get into these and out of these, right, very easily. You can get into these with very small dollar amounts. So the accessibility feature And the nuances of being able to get in and out of the daily liquidity, we think are hugely beneficial. So we are offering public solutions, but we are not opposed to private solutions. We just think it fits a very different need for most likely a very different investor.
Makes sense. And final question, David, in addition to RACs, are AAX, you're also overseeing a number of VanEck model portfolio solutions. For investors who are listening to this and they might not know about, VanEck's efforts on that front, can you tell us a little bit about what types of exposures they're designed to provide?
Yes. So if investors are not aware of our solutions on the model side, we'd encourage them to go to vaneck.com and look at them. We've got a model solutions page. Generally speaking, we offer a suite of models. So we've got both thematic offerings as well as core solutions. And our core solution suite is called Wealth Builders. And Wealth Builders, you can have it with or without Bitcoin. So we've got the option to do both. Those portfolios are differentiated in regards to how much diversification they have. I'm going to be more specific now. We do not believe a 60-40 portfolio is a well-balanced portfolio. We believe a truly well-balanced solution is equities, fixed income, real assets, and digital assets. That's how we think about investing. Once you're invested in a truly diversified asset allocation, as we just laid out, now you've got a portfolio well-positioned to perform independent of the economic regime. And those economic regimes include what we're experiencing right now: higher inflation, deaccelerating growth, right? You can have accelerating growth, decelerating inflation. Once you have a truly diversified asset allocation mix, when you rest your head on your pillow at night, you can feel comfortable that you've got a portfolio well-positioned to navigate whatever gets thrown at you. That's the purpose of that. And if there's any message that gets across today, it's that of diversification. That's all. We're preaching diversification. If you're not diversified into gold, don't wait. We just got a recent pullback in gold. Gold's at $3,200 an ounce. It was over $3,400 an ounce. That gives you a buying opportunity if, in fact, you don't have that. People should have exposure to diversified real assets as well.
Fantastic. Well, David, a ton of great information. I really want to thank you for your time.
Thank you so much. It was fun.